John, in your last market update, we heard the global economy was still fairly volatile. Would it be fair to say that the markets are looking much more positive this quarter?
It's certainly a little more positive, Danielle, but the markets are very volatile, probably the most volatile markets that I've ever experienced. This is all due to the continuing uncertainties in Europe and the US, and we've been waiting to see what sort of sanctions are going to be put in place to fix the problems, and it's mainly politically driven rather than market driven. So recently we've seen the Europeans put in place a bailout package, a financial package to underpin economies like Greece that have got debt issues. That isn't actually in place at the moment. It's been resolved but not put in place. The interesting thing about this package is that it also includes more powers by the central controls in Europe, so that they can participate in the secondary bond market, which could mean that they might buy bonds from banks, and they can also participate in long-term lending at low interest rates to troubled countries. So there are two things that didn't exist before, which give greater control over the situation. So that's all very positive. In the US, the President has recently delivered a speech which included cuts to payroll tax and increased expenditure on infrastructure projects to try and stimulate the employment market. We see this as being a really good development rather than a QE3, another economic stimulation package. The President of the Reserve also, in his speech, Ben Bernanke, said that he thought that the US economy had sufficient growth to avoid having to launch another stimulation package. So I think they're all very good and positive things, but they're going to take time to resolve, and we just have to be patient.
Can the same be said for Australia? Can investors be expecting the same level of growth?
Well, Australia's experiencing one of the biggest economic booms in its history. But it doesn't feel like it, does it? And that's partly because of the two-speed economy that, while the mining industry is booming, other sectors such as construction and retail aren't doing so well. This is really a lack of confidence in the Australian community. On the other side, we're seeing record savings at a domestic level. So people are saving money, they're not spending, waiting to see what's going to happen. So I think once these things resolve, that the economy will show good signs of growth, and we'll all respond to it. I'm really very positive about the Australian economy.
Given the financial markets have been extremely volatile, people are worried about their investments. What advice can you give to clients in this difficult period?
Yes, look, it's been very difficult for people, and not helped by the headlines when the markets go down 300 points one day and back the next, and we see headlines like $30 billion wiped off the Australian share market. Conversely, we don't see a headline the next day saying $30 billion added back to the Australian share market. So it is very worrying, and people, I guess, find it difficult to understand all of this. But this is a market-led volatility. It's not to do with the specific intrinsic value of shares. So people need to perhaps look through that, try and keep calm, hang on to their quality assets.
So it's not a time to be selling off your assets?
If you own quality assets, there's no need to sell them. More likely, this is a good time to be buying them at a cheap price. The power of long-term investing is profound, and to give an example of that, we did an exercise taking 15 of blue chip shares that would be commonly held by our clients' portfolios over the past 15 years, and did an appraisal of the performance. And the outcome was quite astounding, in that through the power of not only just the growth of the shares, but also the growth in the income of the shares, we found that over the period, the average income return per year is 15.6%. The overall return be 32.1% per annum. Now, they're just extraordinary growth figures for doing nothing more than hanging on to quality assets over time. So that looking at share performances or looking at portfolio performances over a 1, 3 and 5 year period isn't necessarily the thing to do, particularly when in a market like this. People need to be taking a far more long-term view and understand just how powerful the growth in dividend income can be. So my advice is set your portfolio asset allocation, rebalance often, and stick to your strategy.
Now, John, with the government having released the first tranche of the Future of Financial Advice reforms, which has been widely reported in the media recently, what's your view on the proposed legislation?
Oh, look, by and large, we agree with the proposals in the reforms, with a couple of exceptions. Certainly, the banning of upfront and trail commissions is something that's long overdue, and we certainly support the introduction of a fiduciary responsibility. Although that has, in our mind, has always existed, it's good to see it written in law. The 2-year opt-in requirement is probably an administrative nuisance, but I can understand why they've done it, because it's really a fallback to trailing commissions, and particularly in respect to gearing investments. The next round of reforms is expected to include kickbacks and volume bonuses from platforms. These are payments to advisory firms that come from usage of a administration platform or a particular product. Again, we think this is a good development. We're disappointed that the ban on commissions didn't extend to life insurance. We are great believers in fee-based life insurance. The commission system overprices life insurance and discourages people from being properly insured.
What are the likely implications of these reforms on the advice industry?
Yeah, we've already seen quite a bit of fallout from these reforms, particularly with some of the revenue models. There have been a number of mergers and acquisitions and people selling out of businesses because their business model doesn't suit the change in reforms. So there's going to be a reorganisation of the advice industry. I guess what that will mean is that the larger groups, the banks and so on, will buy up a lot more financial planning firms and dominate that. Well, they already dominate the industry. They already control about 85% of advisors in Australia, which we don't readily agree with. We're not fans of the institutionalisation of financial advice. So there's a lessening of the independent firms in the market.
Will this have any effect on Hewison Private Wealth and its clients?
No, it won't affect us in any way at all. It'll be business as usual. We've always been fee-based and have no intention of changing that. Look, this is all about a differentiation between product and advice. We've never been product-driven. It's all about the advice and the client, so that has really no impact on us whatsoever.
Thanks, John.
Thanks, Danielle.